a debt-based monetary system, the currency is backed by bonds, also known as debt. This is not the vision of our fathers who wanted us to have an asset-based monetary system. In a debt-based system, everything seems fine until the economy contracts, and when it does, as we're seeing now, it threatens to collapse entirely. Any idea how much debt America currently owes? The following are pictures of the Empire State Building, a football field for our football fanatics, a 747 airliner, the Statue of Liberty, and the Twin Towers. And the structure next to them is a stack of $100 bills. What does that equate to? Between federal, state, and local governments, along with unfunded liabilities of Medicare and Social Security, it's been estimated the national debt stands at over $114 trillion. To put this into perspective, consider the following calculations. 1 minute equals 60 seconds. 1 hour, 3,600 seconds. 24 hours in a day, 86,400 seconds. 365 days in a year, 3,536,000 seconds. If one started counting $100 bills at 1 per second for 24 hours per day, 7 days per week, 4 weeks per month, 12 months per year without stopping to eat nor sleep, any idea how long it would take to count out 114 trillion? By dividing 31,536,000 seconds into 114 trillion, it would take 36,149 years. Obviously, the debt can never be repaid. In turn, the honest thing for Ben Bernanke to do is to appear in federal court and file for bankruptcy. But he's not going to do that. Instead, he's going to continue printing, thus digging the debt hole deeper. What he's doing to our progeny is tragic. The above figures do not take into account derivatives. Any idea why the government agreed to take over AIG? Because its derivatives book stood at $1.6 trillion. The following is a 20-year chart of AIG. Back in 2000, its share price was just north of $2,000, and today it stands at only $33. This equates to a collapse of 98%. Back in 2008, AIG owed Goldman Sachs billions and was on the brink of going out of business when Hank Paulson, Treasury Secretary, stepped in and bailed them out. Any idea who Paulson worked for just prior to him joining the Treasury? That's right, Goldman Sachs. During the 2008 panic, JP Morgan received $25 billion from the U.S. Treasury and $68 billion from the Federal Reserve. Their total net derivative exposure is $79 trillion. And 35.4% is rated below BBB, highly speculative, which is much worse than Bear Stearns and Lehman Brothers' derivative portfolio just prior to their crash. During the 2008 panic, Citigroup received $25 billion from the U.S. Treasury and $99 billion from the Fed. Its derivatives book stood at $37.1 trillion, and today it's $54.1 trillion, an increase of 45% in just 3 years. During the 2008 panic, Bank of America received $15 billion from the U.S. Treasury and $91 billion from the Fed. Their derivatives book stood at $39.7 trillion, and today it stands at $52 trillion. An increase of 32%. By the way, the following is a 1-year chart on Bank of America. Note, in January 2007, its share price was over $55, and here it sits today at $8.80. This is a decline of 84%. Whenever the price of stock drops below $5, it's considered a penny stock. Could Bank of America become a penny stock? During the 2008 panic, Goldman Sachs received $10 billion from the U.S. Treasury and $69 billion from the Fed. Their total derivative book stands today at $44.9 trillion. The Business Insider said, while Goldman Sachs was helping Greece hide its debt from the official statistics, it was also hedging its bets through buying insurance on Greek debt, as well as using other derivative trades to protect itself against a potential Greek default on its debt. So while Goldman Sachs engaged in long-term trades with Greek debt, meaning Greece would owe Goldman Sachs a great deal down the line, the firm simultaneously was betting against Greek debt in the short term, profiting from the Greek debt crisis that it helped create. Back in its heyday, Goldman Sachs was trading above $225 per share, and here it sits today at $116. This is a decline of nearly 50%. Ellen Brown, lawyer and author of the book Web of Debt, wrote, "The Bank of International Settlements recently reported the total derivative trades exceeded $1 quadrillion. That's 1,000 trillions. How is that figure even possible? The gross domestic product of all countries in the world is only about 60 trillion. The answer is that the gamblers can bet as much as they want. They can bet money they don't have. And that is where the huge increase in risk comes in. And as you see, the banks get to keep their profits on the way up. But when everything comes crashing down, they want us to bail them out." Bank of America's liabilities are 36 times greater than assets. J.P. Morgan Chase's liabilities are 46.1 times greater. Citibank's liabilities are 46.6 times greater. And would you believe, Goldman Sachs' liabilities are a shocking 533 times greater than their assets. These four institutions have an outstanding derivative book totaling $234.7 trillion. This is absolutely outrageous. All it will take is for one institution to fail, and it will literally pull the rest down with them. And guess who they'll want to bail them out? Us. This is what 234 trillion looks like. Chapter 19 of Conquer the Crash states, between 1929 and 1933, 9,000 banks in the United States closed their doors. President Roosevelt shut down all banks for a short time after his inauguration. In December 2001, the government of Argentina froze virtually all bank deposits, barring customers from withdrawing the money they thought they had. Sometimes such restrictions happen naturally when banks fail. Sometimes they're imposed. Sometimes the restrictions are temporary, and sometimes they remain for a long time. Why do banks fail? For nearly 200 years, the courts have sanctioned an interpretation of the term deposits to mean not funds that you deliver for safekeeping, but a loan to your bank. Your bank balance then is an IOU from the bank to you, even though there is no loan contract and no required interest payment. Thus, legally speaking, you have a claim on your money deposited in a bank. But practically speaking, you have a claim only on the loans that the bank makes with your money. Conquer the Crash continues. Because U.S. banks are no longer required to hold any of their deposits in reserve, many banks keep on hand just the bare minimum amount of cash needed for everyday transactions. Others keep a bit more. According to the latest Fed figures, the net loan-to-deposit ratio at U.S. commercial banks is 90%. This figure omits loans considered securities, such as corporate, municipal, and mortgage-backed bonds, which from my point of view are just as dangerous as everyday bank loans. The true loan-to-deposit ratio, then, is 125% and rising. Banks are not just lent to the hilt, they're past it. Conquer the Crash goes on to say, if a large portion of these loans is tied up or becomes worthless, your money claim is compromised. A bank failure simply means that the bank has reneged on its promise to pay you back. The bottom line is that your money is only as safe as the bank loans. In boom times, the banks become imprudent and lend to almost anyone. In busts, they can't get much of that money back due to widespread defaults. If the bank's portfolios collapse in value, say like those of the savings and loan institutions in the U.S. in the late 80s and early 90s, the bank is broke and the depositor's savings are gone.